Imagine logging into your SARS e-filing profile. You haven't typed a single number.
Right, you haven't uploaded a single document at all.
Exactly. But there's already this massive tax bill waiting for you. It's pre-populated and just ready to completely derail your year.
Oh, it's terrifying.
It really is.
Yeah.
And why? Well, because of a clerical discrepancy your family trust made like 6 months ago that you didn't even know about. Welcome to the new reality of wealth building in South Africa.
It is just a massive wake-up call for business owners and investors. I mean, for decades, the mindset has been, I own it, so it's mine, and the paperwork can just wait.
Right. Deal with it later.
Yeah, exactly. But legally, if your wealth is sitting in your personal name, or if your trust admin is sloppy, everything you spent your life building is completely exposed.
Which is the core mission of today's deep dive. We are exploring the ultimate solution to this vulnerability, which is setting up what's known as an asset protection fortress using a trust.
A hugely important topic right now.
Totally. We're going to unpack the massive, generational benefits of properly structuring your wealth in South Africa. But we're also looking at the catch.
Because there's always a catch.
Always. SARS has rolled out this ultra-strict digital reporting framework that basically leaves zero margin for error.
Yeah, the era of the informally managed family trust is definitively over. You cannot just throw assets into a trust and figure out the tax implications later.
So to navigate how to actually do this right, we are drawing heavily on the methodologies of Lumka Sturman. She's a certified trust consultant and succession planner.
And she specializes in helping entrepreneurs build these exact fortresses, ensuring they get the protection without tripping those new digital tax wires.
Exactly. Her approach is incredibly relevant right now because it bridges two worlds that they usually operate in silos, right?
Right. Aggressive wealth protection on one side and meticulous tax compliance on the other. You simply cannot have one without the other in this new regulatory environment.
So let's start with the wealth protection side. Before we even touch the new SARS rules, we really need to establish the mechanics of why a trust is so incredibly valuable in the first place.
Yeah, why specialists advocate for them so passionately.
Right. Because looking at the default setup for most South African small to medium business owners, it seems like they're basically walking around with a giant target on their backs.
Oh, they absolutely are. The default setup is essentially a house of cards. Most entrepreneurs hold their most valuable assets. So we're talking their primary residence, their investment portfolios, all in their personal names.
Which is inherently risky.
Highly risky. At the same time, their trading companies, the entities actively out there doing business, dealing with suppliers, and taking on liability, well, they often hold valuable assets too, like commercial property or cash reserves.
And to get financing to run all of this, the business owner is constantly signing personal sureties.
Exactly. And that's the fatal flaw.
Because the moment you sign that personal surety, you've basically pierced your own corporate veil. If the business goes down, the bank or the liquidators don't stop at the company door. They walk right through and take your house.
Yeah, and that structural flaw is exactly what Lumka's asset protection fortress concept fixes. The strategy relies on a strict legal separation.
How does that actually look in practice?
The golden rule is simple. Your trust owns the assets, your company carries the risk, and you control everything without holding personal ownership.
So it's kind of like a castle. If your trading company is the battlefield where you're engaging with the market, taking risks, and fighting for profits, the trust has to be the vault deep inside the castle walls.
I love that analogy. Yes.
It's where the actual treasure, the property, the generational wealth is kept entirely separate from the chaos outside. Even if you lose the battle and the trading company is liquidated, the vault remains legally untouchable.
Precisely. By legally severing ownership from liability, you ensure that business risks cannot infect your family's financial security. And, this isn't just theoretical for Lumka.
Right. She has a very personal connection to this.
She does. Her methodology is rooted in a deeply personal origin story that really highlights the real stakes of getting this wrong.
Yeah, her parents were hardworking entrepreneurs. They had a shop, a security company, and a farming business, right?
Yeah. And they were doing everything right by traditional standards, but they hadn't built that fortress. So when a lawsuit hit over an incident on their farm, they almost lost absolutely everything.
Oh, wow. That is devastating.
It was. The trauma of that near collapse changed her family's trajectory forever. It's actually the driving force behind her work as a trust consultant today.
Because if they had just separated those assets into a trust.
Exactly. If they had a trust, the liability would have been contained entirely to the farming entity. The family's core wealth would have been shielded. She realized families deserved the peace of mind that a single bad day or one nasty lawsuit won't erase a lifetime of sacrifice.
And the positive benefits of building this vault go way beyond just lawsuit protection, don't they?
Oh, absolutely. You're setting up the architecture for generational wealth.
We're talking about minimizing estate duty, meaning your family doesn't take a massive tax hit when you pass away, and ensuring continuity.
Yeah, if something happens to you, the business and the assets don't freeze up in the probate process. The trust just keeps operating for your kids. It's the ultimate continuity tool.
And here is the massive pivot. Having an impenetrable vault means you also have to deal with the regulatory guards.
Yes. And recently, those guards, specifically the South African Revenue Service, have implemented a digital net that completely changes how you manage that vault.
This is what we were talking about earlier. It's basically the end of the Wild West for trust administration.
It really is. For decades, it seems like people were treating their family trusts as personal piggy banks, shuffling money around with very little oversight.
Because there was a massive structural gap in South African tax administration, right?
A huge gap. Historically, trusts would report their distributions to beneficiaries on a manual form called the ITR12T.
Okay.
And then the beneficiaries, completely separately, would report the income they received from the trust on their personal tax returns.
But they weren't talking to each other.
Exactly. SARS didn't have the automated computing power to easily cross-reference those two separate filings on a massive scale.
So unless you were unlucky enough to be specifically targeted for a manual audit, all those discrepancies, missing numbers, and informal loans just slipped right through the cracks.
Yeah, but that structural gap is totally gone now. The ITR12T trust tax return is now seamlessly integrated with a new third-party reporting certificate called the IT3T.
Which creates this closed loop.
Exactly, what SARS effectively uses as a closed loop.
Let's break down the mechanics of that IT3T for a second. It functions a lot like the IRP5 certificate you get from an employer, or the IT3B you get from your bank when you earn interest.
Right. It functions exactly like that. The trust is now a mandated third-party data provider.
Oh, wow.
Yeah. The trust has to tell SARS exactly what it gave a beneficiary, detailing the exact nature of the distribution, the exact amount, and the tax year, all via this IT3T certificate.
So SARS gets this data directly from the trust's administrator.
Yes, and SARS now uses that data to automatically pre-populate the beneficiary's personal tax return in real time.
So wait, let me clarify something. SARS didn't actually pass new laws changing how trusts are taxed, did they? They just completely revolutionized the enforcement algorithm.
That is exactly it. The underlying tax laws are identical. What changed is the margin for administrative error. It went from generous to absolute zero.
Old sloppy habits that used to go unnoticed are now instantly visible to a computer.
Instantly. The era of plausible deniability is over. A beneficiary can no longer plead ignorance and say, the trustees never told me I got that money. SARS already has the certificate, and the number is already sitting right there on your e-filing profile.
Limca's case studies highlight a terrifying example of how this plays out in real life with the Williams family.
Oh, the Williams case is a classic. Robert Williams was the classic informal trustee. For 15 years, he ran his family trust based on basically whatever his kids needed at the time.
So he'd just make ad hoc distributions to his 3 adult children.
Yeah. At the end of the financial year, his accountant would try to retroactively piece together an ITR12T from bank statements and Robert's vague memories.
A system built entirely on guesswork.
And then the kids would file their own personal returns based on whatever they remembered receiving.
And it actually worked for them, until the new reporting framework kicked in for the 2024 tax year.
Right. The trust submitted its IT3T certificates. One daughter, Sarah, had R$180,000 reported on her certificate by the trust, but she filed her personal return for only R$150,000.
She had completely forgotten about a R$30,000 payment her dad made to her early in the year.
Exactly. Under the old system, that might have gone unnoticed. Under the new closed-loop system, SARS's automated algorithm flagged the R$30,000 discrepancy within days, issuing an automated query demanding an explanation.
No human auditor at SARS even had to open a file. The computer just caught the mismatch and sent the demand.
Just automated compliance. And while Sarah's issue was just a memory lapse, her brothers had even bigger problems.
Let's talk about Michael.
Right, so Michael had his R$150,000 distribution reported correctly, but he had received another R$50,000 that the trust had retroactively and incorrectly categorized as a loan instead of a distribution.
So his personal return mismatched the trust's return, triggering another automated flag.
Yeah. But the real catastrophe was the third sibling, David.
Oh boy. What did David do?
David had R200,000 on his IT3T certificate, but he deliberately only declared R120,000 on his personal return.
He was actively trying to hide the money.
He was. And that R80,000 discrepancy triggered a formal investigation. He was hit with hefty penalties and compounding interest.
Wow.
What the Williams family considered just minor administrative sloppiness for a decade and a half instantly compounded into a massive stressful compliance crisis for the entire family.
I mean, David's situation makes sense. He was being deliberately dodgy. But the most alarming part of this new digital landscape is that you don't have to be dodging taxes to get in trouble, right?
Not at all.
Completely innocent, logical, administrative mistakes can trigger an absolute nightmare.
Yeah, the automated algorithm doesn't care about your intent. It only cares about data matching. The most common trap right now is timing mismatches.
Like the case of Jennifer Henderson. Let's look at how the calendar basically burned her.
Yes, so Jennifer's family trust approved a distribution of R250,000 for her in January 2024, but the actual cash transfer only hit her bank account in April 2024.
Which crosses a critical tax boundary.
Exactly. The trust's financial year ends in February. So legally, the trust reported the distribution in its 2024 tax return because that is when the resolution was approved and the right to the money vested.
But Jennifer, acting like a logical human being, didn't report the income until her 2025 tax return because that's when she actually had the cash in hand.
Right. And I can guess exactly what the SARS computer did.
In 2024, it saw a massive IT3 certificate for Jennifer that she hadn't declared. Then, in 2025, she declared R250,000 of trust income, but the system found no matching certificate for that year.
Spot on. Both returns were flagged. It required amended returns, formal correspondence with SARS, and expensive professional accounting fees to resolve.
And all over a completely innocent structural timing difference that the family just failed to coordinate.
It's crazy.
Okay, so Jennifer's issue was purely about the calendar. But what happens when the dates align perfectly, but the trust and the beneficiary disagree on what to actually call the money?
Oh, that leads to classification mismatches, which can be even more damaging.
Like the Peterson Trust.
Yes, the Peterson Trust held a portfolio of rental properties. The trust distributed R300,000 to a beneficiary, Thomas. The trust administrator correctly classified it on their IT3T as rental income, which is fully taxable.
But Thomas's personal accountant was given bad information, right? They were told the R300,000 was a payout of the trust's underlying capital, which has very different, often lower, tax implications.
Exactly. The moment Thomas's accountant reported it as a capital receipt, the mismatch triggered an automated query.
And that query didn't just look at that one transaction, did it?
No, it unraveled years of inconsistent classifications by the trust, leading to a massive multi-year compliance review.
I have to push back here on behalf of the listener because there is one specific rule in this new framework that sounds completely counterintuitive. Section 7C.
Ah, Section 7C, yes.
This deals with loans to a trust. I can imagine a listener thinking, wait a minute, I am lending my own after-tax money to my own family trust to help it buy an asset.
Yeah, very common scenario.
Right. So why on earth is SARS penalizing me for not charging myself a massive interest rate?
It is easily the most common frustration among trust founders, but you really have to look at the mechanics of how wealth actually transfers.
Okay, unpack that for us.
Section 7C was explicitly designed to stop tax-free generational wealth transfer. Think about it. If you could lend your trust R10 million interest-free, the trust could use that money to buy a business or a property.
And all the growth on that R10 million happens inside the trust, completely outside of your personal estate.
Exactly. You've effectively frozen the value of your personal estate and shifted all the future growth out without paying any donations tax or future estate duty on that growth.
You're bypassing the estate tax system completely.
Right. So SARS introduced Section 7C. It basically states that if you lend money to a trust at an interest rate lower than the official rate, the difference between what you should have charged in interest and what you did charge is legally considered a deemed donation.
And you are liable to pay donations tax on that phantom amount every single year.
Every single year. And before the IT3T integration, people were just ignoring this. But now you can't hide the loans.
Look at Richard Thompson. He lent his trust R5 million at 0% interest.
Right, and the trust's administrator did everything by the book. They calculated the deemed donation under Section 7C and reported the loan on the trust's ITR12T.
But Richard's personal accountant had no idea the trust had reported this.
Exactly. So Richard didn't declare the deemed donation on his personal return.
The automated system basically matched the trust's declaration of a loan from Richard against Richard's completely empty personal return.
The system flagged it instantly, launching an investigation that uncovered 5 years of unreported donations tax. He was hit with back taxes, compounding interest, and severe penalties.
And the system is equally ruthless in reverse, isn't it? Trusts often try to get beneficiaries money without calling it taxable income, so they label it a loan.
Yes, like Elizabeth Carter's trust. They transferred money to her for years, classifying it as a loan account that eventually sat at R2 million.
No interest was ever charged, and no repayments were ever made.
None. Under the new integrated beta system, SARS looked at the trust, saw it had distributable income, but noted it was making endless non-performing loans to Elizabeth.
And the algorithm didn't even ask questions, did it? It simply reclassified that entire R2 million at a taxable distribution. Overnight, Elizabeth had a catastrophic tax bill.
It's brutal. Looking at these traps, it raises a very valid question for anyone listening. If the compliance environment is this strict, this automated, and this unforgiving, is the asset protection fortress even worth the hassle?
Should people just avoid trusts altogether?
The answer is still a resounding no.
Because going back to where we started, that legal separation between your business risk and your family's wealth is the only way to truly protect what you've built from a catastrophic lawsuit or liquidation.
Exactly. The solution isn't to abandon the castle. The solution is to stop treating the castle's security system like a weekend DIY project.
The cost of informal, sloppy administration is now simply too high.
It's astronomical. Operating a trust requires professional intervention to ensure absolute, verified alignment between the trust's actions and the beneficiary's tax returns before anything is ever submitted to SARS.
Trying to manage a modern trust without a specialized consultant is like trying to diffuse a complex explosive device using a 5-year-old internet tutorial.
That is painfully accurate.
The wires have all changed colors, the timer is counting down much faster, and you desperately need a professional who knows exactly which wire to cut. This is where working with a specialist like Limca Sturman becomes a non-negotiable part of your wealth strategy.
Yeah, what is highly effective about her framework is that it structurally eliminates every single automated trap we just discussed.
Because to avoid those timing and classification mismatches, trust can no longer operate on verbal agreements or retroactive paperwork.
No, her methodology demands formal, real-time documentation. Under her framework, a compliant trust operates with formal, quarterly resolutions.
So if trustees approve a distribution, they sign minutes right then and there.
Yes, specifying exactly who gets the money, the exact amount, whether it's capital or income, the underlying source of the funds, and the exact payment date.
And within 7 days, the beneficiary receives a formal, legally binding distribution letter stating exactly how this will appear on their upcoming IT3T.
But the most critical step in her methodology is coordinated year-end reporting.
Right, before the IT3T is ever uploaded to the SARS portal.
Exactly. The trust administrator and the beneficiary's personal accountants must sit down and reconcile their figures. If there is a discrepancy, they identify and fix it before they file, entirely preempting the automated algorithm.
But what if you're listening to this and a cold sweat is breaking out because you know your family trust has been operating informally for the last 3 years?
It happens all the time.
And there were definitely undocumented loans and missed distributions sitting in your history. What do?
You still have options, but you have to act preemptively. SARS has a mechanism called the Voluntary Disclosure Program, or VDP.
Okay, how does that work?
If you come forward and legally declare historical noncompliance before their automated systems catch you, you can secure drastically reduced penalties and avoid criminal prosecution.
But navigating a VDP definitely requires an expert.
Oh, absolutely. If you misstep during a VDP application, you essentially hand SARS all the evidence they need against you on a silver platter.
This is why bringing in a trust consultant isn't just about filing forms, it's about structural peace of mind. When you look at Limca Sturman's specific approach, she lays out very clear, methodical paths for business owners to get compliant.
Her methodology is actually structured in stages. She usually starts clients with a foundation audit.
Which is critical because most business owners don't actually know where their liability ends and their personal assets begin.
They really don't. So she analyzes your marital regime, existing personal suretyships, and assesses if you actually have the right risk profile to require a trust in the first place.
From there, she moves to the asset protection blueprint. And this isn't just a boilerplate document, right?
No, not at all. She custom designs the exact flow of assets, mapping out how the trust and the trading companies will interact safely, and provides a clear guide on maintaining SARS compliance within that specific structure.
And for clients who need the architecture built from the ground up, she offers a full asset protection fortress setup.
Yes, an end-to-end implementation. It includes entity restructuring, legally drafting the trust deed, establishing the compliance files, and providing ongoing support to ensure the trustees actually build the right operational habits.
But the standout feature of her framework, especially given the new digital net, has to be the ongoing annual maintenance.
Or what she calls fortress checkups. She manages the annual trust resolutions, actively hunts for red flags like those Section 7C loan issues, and ensures that when tax season arrives, the IT3T and ITR12T forms are in absolute perfect alignment.
Her entire practice is built around education and integrity.
Yeah, she ensures the client isn't just handing over paperwork to a black box, but actually understands the mechanics of how their fortress operates and protects them.
So let's bring all of this together. If you are an entrepreneur, an investor, or professional building significant assets in South Africa, a trust remains the absolute ultimate tool for securing your family's future.
Without a doubt, you absolutely need that vault to separate your treasure from the battlefield of your business.
But the operational landscape has fundamentally changed. The new integrated digital system is an automated, closed-loop machine.
Every timing error, every informal loan, and every classification mismatch is instantly visible and instantly penalized.
Professional guidance is no longer a luxury for the ultra-wealthy. It is a fundamental requirement for anyone operating a trust today. Do not leave your life's work exposed to an automated algorithm.
I couldn't agree more.
We highly recommend exploring Lumka Sturman's educational resources and booking a consultation. You can find her framework and get started on building or fixing your compliant asset protection fortress by visiting her website at www.lumkasturman.com.
Yeah, definitely check it out. And as we close out this deep dive, there is one final, broader trend you really need to consider.
What?
We've spent our time analyzing SARS's new digital matching within the borders of South Africa, but this domestic digital transformation is merely the first step.
Wait, where does this regulatory net expand to next?
The global financial system is moving rapidly toward ultimate trust transparency, primarily to combat international money laundering and tax evasion. We are entering an era of seamless cross-border information exchange.
Oh, wow.
Yeah. If SARS domestic computers catching a R30,000 local discrepancy makes you nervous, consider what happens when your business or trust structures span across multiple countries.
Her data just flows everywhere.
Exactly. International revenue services are beginning to automatically share your data in real time.
That is a staggering thought. If you think the local guards at the vault are strict, wait until the international guards show up with a unified database.
It proves that setting up an airtight, fully compliant structure right now isn't just about this year's tax return. It's about preparing for a totally transparent global future.
Protect your wealth, build your fortress, but make absolutely sure the architecture is flawless.